Switzerland is home to some of the richest people in the world, with 40 of the world's richest billionaires being Swiss citizens. Switzerland's economy is one of the most advanced and developed mixed economies in the world. The service sector, as well as political and economic stability, has grown to play an important economic role, particularly in the Swiss banking industry and tourism. Switzerland's economy has been ranked first in the world on the Global Innovation Index since 2015 and third in the 2020 Global Competitiveness Report. According to United Nations data from 2016, Switzerland is the world's third wealthiest landlocked country, trailing only Liechtenstein and Luxembourg. They are, along with Norway, the only three countries in the world with a GDP per capita of more than $90,000 that are neither island nations nor mini-states. 2022 was one of the worst for the finance industry. Following the coronavirus pandemic-induced lockdowns and Russia's invasion of Ukraine, global inflation skyrocketed. Inflation rates in major economies around the world reached new highs not seen in decades. As many countries around the world battle stubbornly high inflation, price increases in Switzerland have been far less dramatic. But how is Switzerland winning the race against inflation?
It's because people are on average quite rich. The share of food in the overall budget of household is not as big as maybe in other countries. We also have inequality, of course, but from an international perspective, we have, I think, a very well-functioning social policy.
Switzerland's GDP per capita exceeds that of other developed countries, such as the United States, Japan, and Germany. Hence, it is one of the world's richest countries. Furthermore, the country is home to some of the world's wealthiest people, with an average adult wealth of $696,604. In addition to its high cost of living, the country has a high concentration of wealthy citizens. The Swiss cities of Zurich and Geneva remained among the top 10 most expensive cities in the world last year. This is despite rising living costs in other high-end cities such as Singapore and New York. As a result, price increases often have less of an impact on Swiss citizens. This is due to the fact that they spend a smaller proportion of their income on necessities, such as food and housing, than on discretionary items. Let's take a look at the factors that help Switzerland to beat inflation. A strong currency contributes to Switzerland's relative pricing stability and battle against inflation. The value of the national currency has steadily increased, and it is expected to equal the euro. Throughout Europe's turmoil, the Swiss franc remained stable, while several other currencies fell against a rising US dollar. This is largely due to its role as a safe haven currency. Because of a large reserve of gold, bonds, and other financial assets, the Swiss National Bank can guarantee the stability of the Swiss franc during market volatility. Every year, Switzerland imports around $302 billion in goods and services, the vast majority of which come from neighboring EU countries. A stronger Swiss franc effectively discounts those imports. Meanwhile, Switzerland exports nearly $305 billion per year, primarily higher-value goods and services, such as watches and pharmaceuticals, which are less susceptible to price fluctuations than low-margin, mass-produced commodities. Switzerland's fight against inflation is most likely aided by a wealthy society and a stable national currency. Other countries are unable to combat inflation in the same way that Switzerland has because most countries do not have such a large proportion of their citizens in the ultra-wealthy class. Switzerland is one of the wealthiest countries in the world, with a GDP per capita that exceeds that of other major economies such as the United States, Japan, and Germany. It also has some of the world's richest citizens, with an average wealth of $696,604 per adult, and a high cost of living to match. According to the Economist Intelligence Unit, the Swiss cities of Zurich and Geneva remained among the world's 10 most expensive cities last year, even as inflation drove up living costs in other pricey locales such as Singapore and New York. As a result, Swiss citizens are generally less affected by price increases because they spend a lower proportion of their income on necessities, such as food and lodging, rather than on discretionary items. Because people are on average quite rich, the share of food in household budgets is not as large as it may be in other countries. Of course, they have inequality. However, from an international standpoint, they have a very well-functioning social policy. Switzerland also has strict price controls on goods and services, making them less vulnerable to inflation-driven fluctuations. Almost one-third of the core products used to measure inflation in the Eurozone, including food, housing, and transportation, are subject to price regulation in Switzerland more than in any other European country. In December of last year, Swiss food prices rose at an annualized rate of 4%, compared to 11.9% in the United States, 16.9% in the United Kingdom, and 19.8% in Germany. Because of high tariffs on certain agricultural imports, domestically produced foods, such as milk and cheese, are preferentially priced and less affected by global food market movements. As a result, the country's economy has been boosted. Switzerland is also less vulnerable to some of the external factors that drove up prices in 2022 to 2023, such as Russia's war in Ukraine. Switzerland, with its mountainous terrain and more than 1,500 lakes, is less reliant on oil and gas imports than some of its European neighbors, with hydroelectricity playing a significant role in its energy supply. Swiss energy suppliers are also largely publicly owned, which means they are less vulnerable to extreme market volatility due to financial safety nets, despite being subject to stricter pricing regulation. Energy prices in Switzerland rose at a 16.2% annual rate in 2022, trailing major peers such as Germany, 25%, the Netherlands, 30%, the United Kingdom, 52.3%, and Italy, 64.7%. According to the country's energy regulator, prices will rise by another 27% in 2023, with the average household energy bill exceeding 1,215 Swiss francs. This is not to say that Swiss consumers have been completely immune to recent price increases. However, the Swiss National Bank stated in December that inflation will average 2.4% in 2023 before falling to 1.8% in 2024. That would fall short of the bank's 2% target. Nonetheless, economists believe it is unlikely to harm the economy.
Even if we have kind of a recessionary scenario, people are still coming in, and that of course stabilizes demand. And I expect the same thing for this year, 2023, and probably also for 2024.
Switzerland's remarkable success in conquering inflation offers valuable lessons for other countries facing similar challenges. By prioritizing the independence of the central bank, employing inflation targeting, implementing sound monetary and fiscal policies, nurturing social partnerships, emphasizing education and innovation, and managing currency effectively, countries can build a robust framework to combat inflation. While each nation's circumstances may differ, Switzerland's experience provides a roadmap for achieving and maintaining price stability, bolstering economic growth, and safeguarding the well-being of its citizens. The Swiss economy has long been admired for its stability and resilience, and there are valuable lessons that other countries can learn from their approach. Firstly, Switzerland's commitment to maintaining a strong currency has been a key factor in their fight against inflation. By implementing sound monetary policies and keeping a close eye on exchange rates, they have managed to foster confidence in their currency and attract international investors. This has helped them avoid the vicious cycle of inflation and ensure economic stability. Secondly, Switzerland's emphasis on a diversified and innovative economy has played a significant role in combating inflation. By investing in research and development, promoting entrepreneurship, and nurturing industries beyond the traditional sectors, Switzerland has fostered sustainable economic growth. This diversification has acted as a buffer against inflationary pressures, making their economy more resilient. Another important lesson from Switzerland is their focus on fiscal discipline. Through prudent fiscal policies and a commitment to maintaining a balanced budget, Switzerland has managed to control government spending and reduce the risk of inflationary pressures. This disciplined approach has helped them avoid excessive borrowing and maintain economic stability. Lastly, Switzerland's strong social dialogue and cooperative approach have contributed to their success in managing inflation. The Swiss government, businesses, and labor unions actively engage in discussions and negotiations to find consensus on economic policies. This collaborative effort ensures that the interests of all stakeholders are considered, leading to effective and sustainable solutions to combat inflation. In conclusion, Switzerland's ability to beat inflation stems from its commitment to maintaining a strong currency, fostering a diversified and innovative economy, practicing fiscal discipline, and embracing social dialogue. These principles can serve as valuable lessons for other countries looking to address inflationary challenges and achieve long-term economic stability. If you found this video informative, be sure to give it a thumbs up and subscribe to our channel for more insightful content. Don't forget to leave your comments down below and let us know which country you'd like us to explore next. Until then, stay curious and keep learning.